right, folks, kicking things off, if you've been following mortgage news, you probably saw the headline 30-year fixed rates just dropped to 6.50%. That's officially the lowest we've seen since, well, October last year. Lior, I feel like we were just talking about how the market was kind of slogging along, and now, bam, here's a proper dip.
Yeah, Ruby, it's a big move. And you know, the timing is interesting. I mean, just last week, Freddie Mac's survey had the average rate at 6.56%, which, let's be honest, is not bad if you compare it to late 2024. But this 6.50%. It's the best case you see for borrowers who are like A+ material. Not everybody gets that, but it shows the direction things are headed.
Totally. And I always have to remind people, those Freddie Mac numbers, you see them everywhere, right? They actually come from weekly surveys, so they're always a little behind the times. Whereas you check something like Mortgage News Daily every morning while I'm making my coffee, and you get what's basically a snapshot of where rates truly are, right then and there.
Exactly. I just had a client recently. He's texting me at all hours. What's the rate now? And I'm like, it depends where you look. You got to remember these numbers can shift fast after something big happens. Like, you remember the Fed meeting or Powell's speech?
Yeah, actually, I'll never forget the first time I had to track rate swings for a client story. I was up at 11 p.m. refreshing daily trackers, and by the next morning, everything had changed. Makes you realize the market really does move on a hair trigger, especially when people are waiting to lock in a good deal.
Right. And that's why real-time data is, let's say it's gold. If you blink, you might miss your shot at a lower payment. Which, speaking of, maybe that's a perfect lead-in to what it means for buyers today.
Yes, because for buyers, this isn't just some headline stat. When rates dip to 6.50%, suddenly houses that seem just out of reach become a lot more doable. Your monthly payment shrinks, your budget goes further, even if you're not the absolute top-tier borrower.
It's a huge difference, especially for, let's say, the typical buyer with decent but not perfect credit. Their rate might be a bit higher than 6.50%, but it still comes down compared to a few months ago. And of course, there's variation between lenders and which market you're in. New York's very different from, I don't know, Kansas City.
Oh, for sure. I mean, I've got mates back home in Melbourne, and they can't believe how wildly different things can be lender to lender or zip code to zip code here. But you just mentioned New York, Lior. You had someone finally buy after watching rates go down, right?
Yeah, true story. Had this couple looking for months, watching the numbers almost obsessively. The second the rate hit 6.50%, their buying power improved enough that they could make a move on their dream place in Brooklyn. I mean, a drop of even a quarter point changes the whole math. They've been edged out before, but now they're homeowners.
Love that. And it's not just about the monthly numbers either. It's the confidence shift. Suddenly people feel like, maybe I don't have to wait forever or keep renting another year, especially if the headlines keep flashing new lows.
Yeah, but it can also, heat up the market again, make it competitive. People are jumping back in. That urgency, act now before it goes away.
Definitely. And as we've talked about in some other episodes, like the one where we covered those narrowing mortgage spreads, the window's not always open for long, right?
Exactly. And we saw that before too. Okay, so the obvious question, why did rates even drop like this anyway? And are they going to stay there?
Oh yes, time to get into the weeds. It really does come down to the Federal Reserve, good old Jerome Powell. After his speech at Jackson Hole, markets basically started betting that rate cuts might come sooner, or maybe just less hawkishness from the Fed this year. And the bond market, well, it reacts instantly, and that trickles straight into mortgage rates.
Yeah, I mean, every word Powell says, Wall Street listens, the mortgage market listens. If he signals that, maybe inflation's cooling and policy could ease off, mortgage rates start shifting before any official move. We talked about this way back at the start of the year. Sometimes it's not even the action. It's just the market reading the tea leaves.
And that's why rates are so stubbornly responsive. That's also what makes it, a bit of a gamble. You get people asking, should I wait and hope for 6% or just grab the 6.5% and run?
Yeah, and there's no clear answer. Like, if you lock now, you have certainty. And if rates keep dropping, well, maybe you can refinance. If not, you don't risk missing out if they bounce back up. But trying to time it perfectly is not realistic. Unless you have a working time machine, in which case, call me first.
No, but really, that's the advice, right? If the number works for your life, don't get fixated on catching the absolute bottom. And like we said in that episode on forecasting, focusing on your own budget is way smarter than chasing what might or might not happen.
Totally agree. Focus on the actual payment, not the headlines. Nobody gets the best day every time. Markets change, Fed messages change, sometimes overnight. That's just part of the game.
All right, I think we'll leave it there before I try to predict the next Fed move and embarrass myself. Thanks for tuning in, everyone. Lots more to come on Nadlan Forum Podcast Daily, of course. Lior, thanks as always, mate.
Always a pleasure, Ruby. Good luck out there to all the buyers listening. We'll catch you next time.